Welcome to the Commercial Real Estate Show, America's choice for commercial real estate market intelligence, forecasts, and success strategies. Hello, I'm Michael Bull, the host. Thanks for being with us on one of the radio stations around the country, or maybe you're listening on iTunes or on YouTube. Thanks for being with us. Well, today we have an incredible show for you. We're going to talk about retail and retail real estate. So we're going to look at the market and what's been going on, where we stand in the marketplace performance-wise, what we expect to moving forward into 2017. We'll also talk about investment market, about cap rates, about new supply. We'll also look at the impact of rising interest rates, what that might do to retail investment real estate prices and values. Plus, first, please welcome my first guest. It's Victor Calanog. He's the chief economist with Reis, and he's joining us on the phone today. Victor, thanks for being with us.
Thanks for having me, Michael.
Well, we appreciate it. And let's talk about property level performance. What have you seen for rents so far in 2017? We're not 2017 yet, in 2016. What are the trends so far?
So when we're taking a look at a variety of property types in the retail sector, you kind of see some of them taking a couple of steps forward and one taking one step back. If you take a look at asking an effective rent growth for neighborhood and community shopping centers, you know, Michael, you've got about 4 billion square feet of these strip malls around primarily suburban locations around the U.S. Back when our large swaths of our population moved out to the suburbs in the 70s or 80s, these really sprung up, usually anchored by a grocery or pharmacy center to service the primarily suburban population. And for those guys, which always used to be perceived as a stable property type, asking rents increased by 0.4% in the third quarter, and effective rents also increased by 0.4%. That's a slight slowdown versus any prior quarter or year-over-year measure that you're taking a look at. And I don't think it should be surprising, given that the first half of this year was really characterized by a whole lot of uncertainty around the investment environment and whether or not the upcoming election on November 8th will affect the economy in positive or negative ways. When you take a look at malls, on the other hand, the regional malls typically have outperformed the smaller shopping centers, given that they typically cater to wealthier consumers, especially the Class A malls. You've got vacancy rates here at 7.8% versus vacancy rates of about 10% for neighborhood and community center retail. And here, rents have grown by around 0.4% in the second quarter and another 0.4% in the third quarter. So whether you take a look at rents or vacancies, it does feel like for a lot of retail brick-and-mortar properties out there, it's a pause before the storm where we're growing rents, vacancies are bouncing around at somewhat declined since their peaks in 2011 or so, but not a whole lot of health or robust movement from a fundamentals point of view.
Well, let's put that third quarter rent increase number in perspective for the listeners and viewers. Victor, how does that compare to last year in the first quarter?
So take a look here. Over the last 12 months, asking and effectives grew by around 1.9 and 2%. Now, for the prior 12 months, it was 2.0 and 2.1%. So it's a whole lot of flatness. And I wanted to contrast this with what's going on in multifamily right now, which is kind of the complete opposite. In 2015, we had rent growths were so high for multifamily on a year-over-year basis that we hadn't seen those kinds of rent growths since 1998 or 1999. In 2016, it's more of a rapid slowdown in the ability of apartment landlords to raise rent. So think about it whether on a glass half full, glass half empty basis. Glass half full, we haven't seen a slowdown in retail rent growth relative to the prior 12 months or the prior quarter, nothing significant. On a glass half empty perspective, it hasn't been growing that robustly in the first place.
Yeah, so it's pretty much kind of tepid growth, and I guess it's kind of running along with GDP, right?
It's very slow and steady, and really it correlates with an economy that's really growing anywhere from 2.0 to 2.1% over the last 6 or 7 years. You're right.
Mm-hmm. So, Victor, what do you expect moving forward into 2017 for performance of retail properties overall?
So what's interesting is that kind of uncertainty and hesitation about the business environment pending the upcoming November elections was really more from the business sector. When you take a look at consumers, when you take a look at household income, where we've seen the first reflected increase in household median income on record in the last 6 or 7 years, right? We're looking at relatively healthy, optimistic consumption patterns on the consumer front. Americans are still out there buying stuff. The real question for brick and mortar retail is, from where are they obtaining these things? Will it be from online or mobile sources, or from brick and mortar properties, which is what we're talking about here? And I think that's what's weighing on brick and mortar retail right now, that ever-present and increasing influence of online sales or e-commerce, which is really making its way into our lives. My suspicion is that for 2017 onwards, unless you've got a handful of star performer property types, like maybe lifestyle centers that cater more towards services that can't be disintermediated by the internet. You've got those outliers. For the most part, when you talk about shopping centers and regional malls, I think they'll still be limping along, given the pervasive developments that we see in e-commerce. So you've got Americans still buying stuff, right? They're okay. They're not getting indebted either to buy all of these things. So I'm not worried about households. But from where are they buying it, and is it necessarily benefiting brick and mortar retail?
Yeah, that's interesting. I was thinking about investing in a cigar bar kind of restaurant that sells cigars, and I thought, well, could that be disrupted by the internet, or even is it? Are people really buying cigars locally because they want to smell them and know they're fresh, or are they buying them online? And I guess that's what a lot of retailers are asking themselves now when they're talking about future growth and rents, right?
Well, to your point, I think a lot of retailers are trying to blend a little bit of both, right? You still sell a physical product, but maybe you'll hold more events with personalities and experts coming in. I'm not sure what the cigar market is like, but maybe you host dinners or cocktails where there are these knowledgeable people. So basically anything that gets people in your store to build your brand and make sure that they walk out with products, as opposed to enjoying your event while they're there and then shopping for better deals online, right? So I think as a retailer, it's always a challenge to really figure out what I think the industry nowadays calls their omni-channel strategy. Really, where do we sell best? Online or via brick-and-mortar stores? You've got, again, some exceptions. You've got some retailers like Warby Parker or Bonobos. These are startups from a few years ago that only sold online. But now they realized that they could actually branch out, and I'm not saying in a large scale like Best Buy. You've got a handful of retail physical locations now, which are kind of helping their brand, and they need to work that out to figure out whether it's actually worth their investment, really putting up these pop-up stores in higher-end places like Brookfield Place in Manhattan, whether or not that's generating significant sales. I think it's going to be an ongoing story for retail properties, not just in the United States, but a lot of these street-level retail in urban areas in the UK and across the world. You're just going to have to deal with this influence of the internet and how people's buying habits are changing.
Right. And I agree. You have to get people in the store. There has to be some type of experience. So I guess if I invest in the cigar place, we'll just do the show, Victor. We'll have you smoking cigars while you do this show, okay?
Exactly. And then I might either be super optimistic or pessimistic. It's hard to tell with these economists how cigars will influence their outlook.
How to put another twist on the show, right? Well, when you guys are talking to investors all over the world, all over the U.S., and they look at the different product types of commercial real estate, how do they feel about retail and the performance moving forward with vacancy and occupancy and the influence of online sales? Are investors a little skittish about retail?
Well, again, it's a bit of a mixed tale, because when you take a look at the overall transaction volume, we will see that at or around 2007, we had about $35.9 billion worth of these properties changing hands for retail, right? We exceeded that number for the first time in 2015. So, though fundamentals have been slow in coming back, you do see a lot of transactions still occurring in the retail space. Again, that's the total dollar volume, But if you take a look at the number of properties that actually transacted, and underlying it could be more expensive properties via portfolio sales too, right? You know, it's right around that cusp for 2015 with about 4,700 retail properties changing hands. Is right. It looks like almost exactly like 2007 in the last peak, where 4,800 properties changed hands. So the average price per square foot is at $218 right now. It was at $200 in the last peak. So you're looking at a fairly constant set of properties changing hands. It looks like investors are looking beyond multifamily, but again, I just wanted to compare it with multifamily because over there the trends have just been relatively explosive as opposed to slow and steady, right? We peaked. We passed peak transaction volume from '07 years ago, and we're building a whole lot of apartments out there. So both in supply growth and investment perspective, you've got people plowing in dollars in multifamily. In retail, it's more, again, slow and steady. We surpassed the previous peak last year. This year, year to date, we're up to around $23 billion. So I don't think we'll hit 2015 numbers from an investment sales perspective. But on the other hand, the mean price per square foot is $232, so it's increasing.
Right.
It does look like investors are being a little bit more choiceful, even though it might mean paying a bigger premium for those properties that are withstanding the storm of the internet. Yeah, the mean cap rate is at around 7.5, and that's down from 7.7. So, you know, it's a changing mix of properties, but it does look like you've got both domestic and foreign investors being mindful of the retail property that they buy.
Okay. So how's that impacting cap rates with these investment sales? You know, that's pretty strong sales volume for 2015. And as you said, 2016 volume slowing down a little bit, but the prices are still looking good on a price per square foot level. So what's that doing to cap rates? What's the trend there?
It's pretty much like the fundamentals, Michael. I mean, it peaked at around 9.1, 9.5% in 2009 once you smooth out some outliers and take a look at maybe the 12-month average. Now we're down to around 7.6% cap rates. That's a fairly and we've been stuck at 7.5, 7.6, 7.7 since 2014. So, you know, despite the fact that interest rates are perceived to be rising at some point, if not soon, then certainly over the next 3 to 5 years as an investment horizon, you've still got cap rates right now trending at relatively low levels. And I think that's what's interesting about just comparing cap rates and valuations versus fundamentals, right? There's a stark difference in multifamily vacancies, and now they've dropped by 400 basis points since their last high. For retail, I mean, I'm just looking at neighborhood and community shopping centers, it's only dropped by around 130 basis points since their previous peak. So fundamentals have been slow, but cap rates pretty much mirror everything else that's going on in either multifamily or office. It's still hugging the bottom, and I suspect the reason for it is the same as what's driving investors to the U.S. despite its 2% growth rate economy. On a risk-adjusted basis, I think a lot of investors out there are saying, where else are you going to put your money, right? If you can pick those retail properties that are income-generating, anchored by a tenant that's relatively reliable, then that kind of investment is going to throw off income that might offset any increase in cap rates 5 years from now.
Yeah. Well, that's interesting. And when you talk about 7.6 cap rate there, you're talking about the grocery anchored and the retail strip centers, right? Average.
Yes.
And
yes.
What about these malls, especially these Class A malls?
So for Class A malls, depending on what we're taking a look at, you're seeing cap rates about 50 to 100 basis points lower, right? And that just means the valuations are higher for these superior malls. I think a lot of REITs like Simon Properties are enjoying that kind of headwind from the fact that their properties really are a little bit better positioned to withstand any kind of risk from online cannibalization. But it's a tale of two worlds, right? So I think in Simon's latest report, you've got their overall vacancies at 5% or lower, But when you take a look at our overall vacancies for malls, it's at 7.8%. So great if you're investing in a Simon Mall, but you've got these older malls out there that might have lost an anchor tenant like Sears or JCPenney's or Macy's, and good luck trying to find a new anchor tenant to occupy that much space. It's, across the street from a lot of these high-performing malls that are transacting, that are keeping cap rates 50 to 100 bips lower than neighborhood and community centers. You've got these, I guess, depending on how you want to call it, gray or dead malls that are really just struggling to keep up and earn enough income to pay expenses.
We're talking with Victor Calanog with Reis about the retail investment market. So you mentioned that you believe rents should increase enough overall to, even with some increase in interest rates, to keep cap rates fairly flat. So is that what you're predicting for maybe 17 and 18? Is retail cap rates fairly flat?
Michael, I would be surprised if retail cap rates spiked or increased significantly over the next 18 to 24 months. And that kind of flies in the face of commonly held projections that if an interest rate environment suggests that things are going to get higher, you're also going to get higher cap rates. Yeah. I'm not saying that over the long run, a higher interest rate environment doesn't suggest a higher cap rate environment. I am just saying that in the short run, even as interest rates begin to rise, I suspect that the residual effect on cap rates and the investment environment will probably be relatively positive and will keep cap rates low. Okay? Let me elaborate. When you take a look at spreads over treasuries, I mean, back in the day, I think during normal times, you've got anywhere from 150 to 250 basis point spread on cap rates for retail versus 10-year treasuries, right? That's your risk-free rate. Right now, we're trading at 350 to 400 bips over 10-year treasuries, and not because retail cap rates are necessarily very low. It's because your 10-year treasuries are bouncing around at 2% or lower, right? So until that spread tightens, I suspect there will be little true upward pressure on cap rates. And I don't expect that spread to tighten very quickly. So over the next 18 months, I suspect cap rates will probably be pretty flat, although conservative risk managers will probably start projecting higher cap rates if your exit period is anywhere from 3 to 5 years onwards.
Yeah, well, that would certainly make sense. And you're talking about average cap rates, but I guess some of the listeners and viewers may not have the Class A institutional mall and shopping center properties. Some of them may have B or more local properties. So I think one thing that let me ask you, Victor. I mean, do you think cap rates will be flat on a B secondary market shopping center, which has a lot less buyer demand?
Right. So there, I think it's on both sides of the equation, both either on buyer demand and potential liquidity for exit, right? In other words, even if you found a buyer, what will that buyer think in terms of exit options, right? And secondly, once you assess the overall trade environment of said B property, you're going to want to think about, well, okay, is this the only game in town for a trade area of 20 to 30 square miles? Then maybe you've got that little bit of a moat where I can pay a little bit of a premium for this property, even if my liquidity options upon exit aren't exactly that broad. That's the kind of idiosyncratic or property-by-property dilemma that makes talking about real estate so interesting, right? I mean, I think that's where you're trying to push me, where I'm like, great, these are overall averages at the national level, but what if you go into these B malls? What if you go into these smaller markets away from the coasts where it's not as liquid? And that's the response. The response is really it becomes more of a local game where as a seller or the broker's representative of said seller, you're going to have to convince the buyer that liquidity options upon exit are existent. And number two, you've got a moat around you that prevents this particular B property, even though it's not charging super high rents, from being eroded by things like online sales or brick-and-mortar competition.
Right. And these investors have a target yield, and if their cost of capital goes up, it's really going to adjust some values. And like you said, if we have the rent increases, that may even offset it as well. Final question for you. What about new supply moving forward? What do you expect for new supply in retail, and how might that impact property performance and values for retail moving forward?
So I am not worried at all about new supply coming online for retail. We've had a small increase in new supply in 2016 and 2015, but it's still minuscule compared to what the kind of stuff we were bringing online, as recently as the year 2000 to 2008, right? I mean, I guess in relative terms, we were banking on a whole lot of retail activity because of all of these homes we were building during the housing boom. As it turns out, a lot of these homes were being bought by flippers, and they weren't actually occupying them and therefore not benefiting said neighborhood center right in the middle of the new suburban location. So you've got this supply overhang from 2000 to 2008 that I think a lot of retail investors are still working through. But moving forward, I just don't see a whole lot of retail buildings in the pipeline, in as much as I'm worried about multifamily and overbuilding in that sector. Over there, the discussion is always overheating, overbuilding. Where is the shoe going to drop? In retail, I do think that even for financing sources, you're going to be hard pressed to find lenders who will take a bet on a new greenfield retail development without significant pre-lease commitment. So if you don't have your anchor tenant and a bunch of non-anchors lined up, good luck getting financing. And that's putting the brakes on any risk that might come from runaway supply growth.
Right, that's a good point to end the segment here. I mean, if there's a limited new supply, that should be at least part good news for performance moving forward and for and property values, right?
Yeah, I mean, as an economist, it sounds strange to be glass half full, but yes, limited supply growth is a boon for retail. It would be, I think the situation would be quote-unquote worse, wouldn't be as flat if we were bringing more product to market that leasing managers just can't lease up.
Yeah, that's a good point. Well, you're being interviewed by an investment sales broker, so it's always half glass full, right?
That's right. It's the same way as developers, right?
That's
build
right.
it, they will come.
Victor, thanks for joining us today. We appreciate you being on the show.
Thanks, Michael. Thanks for having me.
Well, stay tuned. We'll have more on retail and retail real estate. This is the Commercial Real Estate Show. Hey there, thanks for checking out the Commercial Real Estate Show. Don't miss a video of special interest to you. Be sure to subscribe below. And if you appreciate the videos, be sure and thank our sponsors. There's a link to more information about them in the description. For more videos, podcasts, and articles, check out creshow.com.